Good afternoon. Boy, what a good-looking crowd we have today. And everybody looks hungry. Plates are full. We're proud to be the only event that Padres will cater to because they're short of staff, so they had to bring in a whole team of people to make this lasagna for us and salad and everything else. So I really appreciate them, and it's wonderful to have that. Everybody backed by popular demand is Padres lasagna. So we're going to start. This is our spring financial focus event. And let's see, which way do we go? Okay. Disclaimer on what we do and how we do it and everything else. This is not a sales pitch. We're not going to sell anything. Most of you all know that. So we're going to just talk about it. I'm going to talk about what happened last year. Interesting times we're in. Daniel's going to talk about economic trends. Where are we heading? We're in all these investment meetings all the time talking about what's happening, inflation, interest rates, and all kinds of things. So we'll be talking about what we're doing there. And then Jaimee is going to finish up with destructive behaviors and emotional investing. We get a lot of that. If we only had to manage money, it would be a pretty easy job because we don't really manage money, we manage emotions. And we're always trying to help prevent you from jumping off the cliff or jumping out of windows. So that's a harder job than just choosing how to do investments. So we're going to start off, and while you're eating, I'd like you to pull out your survey and the notes that are there, and please make notes, and then if you have questions about anything, you just fill it out, and we can contact you for a meeting.
Silence your cell phones, please.
Whose is that? Oh, somebody's cell phone. It just sounds like it's on the speaker. Okay, no problem. Oh, what is that?
Elevator music, apparently.
Oh.
Okay.
You confused me. Now, you don't need that plugged in now?
No.
Okay. All right. So please fill out the survey. We'd like your feedback. Last time, the biggest feedback we had was we didn't have enough Reese's. So Jaimee made sure we had enough Reese's. If that's the only complaint we have, that's pretty good. But if you have questions, if you have personal, because finances are very personal, and you want to make sure that you're not sharing with the crowd on everything that's going on. So fill it out, and then we can just get back with you. Charity will schedule up a time to meet with us, and meet with us, and we'll help you out. And any notes, okay? And then we're going to continue on here. Uh-oh. Okay, Daniel. I didn't.
Okay, try now.
There. Okay. So I want to share with you. This is a slide I found. Here's a old guy and his son. He goes, "Someday, son, this will all be yours." I just threw this in. It has nothing to do with my talk, but what's happening is we're having a lot of our clients are getting older, and we are ending up helping our clients with helping them go through things and getting them moved into assisted living or with family or whatever it is, and people just have all kinds of stuff that they save, and it's just amazing. And now we're trying to talk to estate sales companies and trying to figure out how do we get rid of this stuff? And there's not much value to it. So if you think it's valuable, call an estate sale company and see how little value, because they're not going to give you much for that. Going the other way. Okay, so for those that are clients, you're still familiar with the merger with TD Ameritrade and Charles Schwab. So it's continuing on. The date that you'll see your information, like the statements and your online information, will be April of 2024. So we have 2 years before anything even happens that you notice. There's a lot of things that are happening behind the scenes. Your money markets are now with Schwab, and you probably don't even notice that stuff. We are starting to see some changes. We are one of the few advisors that they're asking for opinions. So Jaimee, Charity, and I are filling out these surveys and telling them really what we think and what they need to do. So we're really trying to shape how this merger will be. I shared last time what's going on is Charles Schwab, a very smart group of people, and Ameritrade. But what they're doing is they're taking the best of Ameritrade and keeping it and throwing out the worst stuff. And Charles Schwab is getting rid of the worst of their stuff and keeping the best. And the merger is going to be an amazing connection. So very few things will be happening here for a while now. They're behind the scenes, developing and creating all the systems, so it will be very seamless. Okay, so we'll just keep you informed when we see some things that will affect your life. Again, it's affecting ours little by little, and so we'll just keep working on that. And I keep pushing the wrong way. Okay, so, what happened since last time we met? A couple things in our office, by the way. Have you driven by your office? It looks like a mess, doesn't it? We've wanted to landscape that for several years. We applied to the state CDOT to remove the egress in front and put a curb and gutter in there. We never could find concrete contractors, and then this year we found one, and so we got them hooked up, and we're removing that, and we're landscaping, so no longer can you pull straight in and back out onto Townsend. You never should have been backing out onto Townsend. I care about your lives. Every time after you guys leave the appointment, we go back to our offices and we hear cars screeching and horns honking because you're trying to back onto Townsend, which doesn't make sense. So we remove that. So park over on Spruce, and then when you leave, if you have to turn right, that's fine. But if you're turning left, go back around to Columbia. Go back, take Spruce and go around to Columbia and turn at the light. Please don't try to turn left onto Townsend anymore. It's crazy. Let's see, I'm trying to think of anything else that's going on. So with the markets, we have chaos, like we always have chaos, but it's still very chaotic. We're still winding down the coronavirus, we hope, with Omicron virus, more milder. There's supposedly another one coming out, but it's so much more milder, it's just barely even going to be noticeable for people to even know if they even have it. So that's the run that typically happens. Most of these get weaker and weaker because they don't want to kill us off, they just want to live on our body. And so that's what they are. They're parasites, right? They want to live on us. And if they kill us, then they don't do very well. And so we've had an interesting year with the markets last year, and we've had a lot of different changes going on, political, geopolitical, and so on, because we've had with the most recent news is Russia and Ukraine. And what's going to happen there? Are they going to get into a war? Are we going to get into that war and fight over it? It's pretty much all about oil, and energy is a big part of that. North Korea, South Korea, that's still always going on. We have just all kinds of other things happening. Daniel will talk about the interest rates and then inflation as well. So we have a lot of different things happening. And so what happened is we started getting inflation starting to pop up last year. You noticed trying to buy a sheet of plywood at $50 a sheet of plywood when it used to be $15. And so old Ben Franklin is getting smaller and smaller. That's going on, and Daniel will talk about that. It's difficult for investments for us to keep up with the inflation, but if it's parked at a low interest place like at a bank, you're just getting killed. And Daniel will talk about true inflation is currently running around 15%, and it's not really the 7 that the government's telling you. So we really have to manage the money. We have to watch our part, and you have to watch your part. And it's going to continue on. So the markets last year, I would call it, it's bifurcated, where they take a knife and cut it in half there. Part of the markets did very well, and part of the markets didn't do so well. So what happened was, this is a map of the market. This is all 500 companies in the United States, in the S&P 500. And you'll see the big ones: Microsoft, Apple, Google, Facebook. And then you see smaller companies: JP Morgan and Bank of America, United Health, and so on. And so you see reds and greens, a little bit more green than red, but you're still seeing it's pretty split. The big tech companies are very green, and then you're seeing a lot of other smaller companies: Disney, Verizon, Alibaba, Amazon, not doing very well. And so you're seeing that, and yet you're getting two different stories going on. What's happening is the market last year, S&P 500, grew very well last year. But this is called the advanced decline line. Out of the 500 companies, which ones went up and which ones went down? And the ones that, and so this shows you that pretty much about half and half went up. Some went up and some went down, but because those big companies here have so much more weight. Apple is a $3 trillion company nowadays. That has so much more weight than this whole sector right over here. And so it's very powerful. And so you're hearing that the S&P did go up, but you have to understand only about half actually did go up, because the big ones, the few big ones, went up. And so this is also then showing the S&P 500, and this green is showing the green one. That's the top 10 stocks in America last year. And then this is the remaining 490 other stocks. So we call it a bifurcated market going on right now. And so it's just different when you're watching the news. And out of the top 10 companies, you have Apple is at 7% of America GDP. Microsoft and so on, Alphabet, which is Google, Meta is now, was Facebook, and now that's Meta. They call it Meta. Tesla is even, that big. And how many cars does Tesla make? Not a fraction of what General Motors makes or Ford, but yet they're the 7th largest company in America. And NVIDIA and so on. So it's just showing how things are so skewed to technology in here, and you're just getting all these large, and they're all tech companies, until you get down to Johnson & Johnson or Berkshire. Most of those, all others are tech. Even Tesla is basically a tech company. And so then you look at asset classes. What did the best last year? We talked about it last fall, and Daniel tried to explain it to you folks, and it's very difficult. Top one was Bitcoin. Calm down. and then oil, the West Intermediate crude oil, the commodities, and so on. The worst performer was silver, gold, corporate bonds, and so on. And so, again, things are skewed. Bitcoin now has settled down a little bit, and so it's not as strong this year, but it's still quite a force that we have going on. The other thing is I want to talk about, before I hand it over to Daniel here, is countries that talk about trading partners. Remember back, well, you don't remember, but reading in history, hopefully you aren't this old, the Industrial Revolution, right? After Civil War, and in the late 80s and early 1800s and early 1900s, America just got into the Industrial Revolution. And then we had World War II. And after World War II, you can see the trading partners. And here's the United States, and here's all the trading partners we have. The second other largest one is Great Britain. They have a lot of trading partners back in 1960. This is after World War II. And then we have Germany and France. And so those are the big trading partners. So if we move forward 30 years to 1990, how does that change? So you can see how big we are. And now we're over here, and we're still pretty significant. And then you can see, which one is that? I forget that. Is that Japan or China? That's Japan. Here's China. Here's China right down here, 1990. And then here's Germany, pretty big. There's Great Britain, quite a bit smaller. And France is pretty significant. So things look pretty balanced. Now let's move 30 years forward to 2020 and see what happens. Oh my goodness, who is this? Look at their trading partners and look at all the ancillary trading partners and look how small we are. We're half the trading partners we used to have. And these are primary trading partners. We still trade with pretty much any country, but we have shrunk. China has grown exponentially. Germany's held their own pretty much. France has shrunk quite a bit. England is almost non-existent. And I don't know who these two countries that are trading with each other. I don't know who those are, but it's funny to me. But this is the thing that's scary is like we are losing ground on trading partners. Part of that is with the rising minimum wage that's going on, that our cost to produce goods is extremely high. And now with inflation, everybody has to pay people more, and so therefore it's just going to increase cost of goods so much more. We're going to lose a whole bunch. What did I do here? I hate that. So we're going to just lose a whole bunch more of these trading partners here. So I just want to share that with you too, that now it's not necessarily for your portfolio necessarily a bad thing. We just have to maybe shift more to global type of investments instead of just the United States. Years ago when we were very strong, it was pretty easy, but now we have to start looking globally, and not necessarily China, but who is China working with? So wanted to share that with you too. Okay, we're going to pass this over to Daniel. Do you need the mic? Okay, you go.
I'll just go ahead and say what I know you're all thinking. Oh, great, it's that guy. So last year in October, I had the distinct pleasure to consolidate 2 years worth of chaos into a simple 15 to 20 minute presentation. You know, COVID kind of prevented us from getting together like this. So, last time we talked about how the government, the CARES Act, and all the different spending programs and I'm drawing a blank, the stimulus bills. Thank you. So between all the stimulus bills, the government had spent about $6 trillion. We saw a massive, just over-exuberant supply of money being injected into our economy based on all the monetary policy that was implemented to fight COVID-19. So now that we're 2 years outside of COVID, what's been the aftermath? So just to kind of catch everybody up and just to kind of give you a snapshot, this is just tracking the M2 money supply since 1959. When it comes to money supply, you have different varying levels. You have M0, M1, M2. Most people like to use M2. This is basically tracking, your checking account, your savings account, money market funds, CDs, coin, dollar bills out floating around the economy. And so going back from 1959, you can see the percentage change over the years. So we had the 1970s after we were taken off the gold standard. You can see, we had a nice consistent uptick each year, and then we kind of nulled out during the late 80s, early 90s. We had another little peak after the 2008 mortgage crash, and the big number right here for 2020, we saw a 25% increase of the money supply for that year alone. This chart is a little bit stale. The year-to-date number for 2021 is, I think it only goes to like November, but still a pretty big increase. And so to kind of give you zoom out big picture, in just these 2 years alone, we injected and printed 40% of all US dollars that have ever came into existence in just the last 2 years. So with that being said, what was the aftermath? Coffee went up 76%, lumber 59%, Gasoline, 58. Wheat, sugar, up over 20%. How many of us got a nasty bill from Black Hills Energy this winter? Natural gas went up 47%. Corn, 23, beef, 21. The staple of every American diet, bacon went up 20%. Utilities went up 24. Hotels, 28. Used and rental cars went up 37. But don't worry, there is good news. Chicken and fish only went up 10. Ooh la la. And so kind of with all the inflation that's going on in our country, how do we compare to our international neighbors? Well, I didn't have enough time or enough data to consolidate all 195 countries into a single slide, but just to kind of give you an idea, here's about 30 of them. Japan's not doing too bad. They're sitting a little, and this is the most current numbers. Japan's not doing too bad, just below 1%. China and Hong Kong, they're sitting at about 1.5%, 2%. Germany managed to work themselves down to below 5%. And this is just kind of towards the bottom of the list. This is where we're at. We're sitting at about 7.5%. Russia's at 8.7. Turkey hasn't been doing too well in the most recent years. Argentina's the same story. They're seeing a lot of inflationary pressure. And then, Venezuela, obviously, 472% year over year. So we're not the best, but right now we're not the worst. Now you're probably wondering, some of you probably caught this already. You're telling me that everything is up well over 20%, but they're saying that inflation is only 7? How does that work? Whole other conversation for a whole nother time. One thing I will say, and this is kind of me ad-libbing for a little bit, this is just kind of breaking news, so to speak. For hundreds of years, humans had this arrangement with governments. So in like the medieval ages, you would walk up to a king and say, hey, you have an army, you have your own local economy. If you protect us, I will work, live, breathe, die, have kids in your economy. And so and that is even the same nowadays. We live in the United States, we have a military, they protect us. Part of that exchange between rulers and, everyone else, the citizens, is currency. And when you're using a currency, when you're using a kingdom or empire's currency, you are trusting that they are maintaining that currency and they're not manipulating it. When you see a massive manipulation of currency, when inflation gets really bad, what you start to see is people start to have this thing called game theory where they try to figure out, okay, well, if our dollars and our rubles and whatever is declining in value, what is something that we can use that maintains its value, that has stability? In my back home in Arizona, Wendy Rogers, who is a representative in the state Senate, introduced Senate Bill 1341, making Bitcoin legal tender. Now, whether or not that's going to be constitutional, I leave that to the lawyers. Just this morning, Governor Polis announced that the state of Colorado, starting this summer, you can use Bitcoin to pay your taxes. There's a lot, and not even going into Russia, El Salvador, and what's going on abroad, but I'm kind of working on a presentation. I'm going to let you guys know when it's all said and done, just trying to catch everybody up to speed on Bitcoin and just why is this thing taking off. So just keep that in mind. Okay, so we have a lot of inflation. So what do? Well, one thing that happens is our central bank, our Federal Reserve, has two jobs. They have two mandates: maintain maximum employment and maintain price stability. Obviously, we don't have a lot of price stability right now. One mechanism that they use when they tighten monetary policy to fight inflation is raising interest rates. The risk of raising interest rates, yeah, it fights inflation, but you're pushing the brake pedal on the economy. And the problem with that is when you do it too hard or too fast, you potentially put us into a recession, okay? Now, coming out of 2021, going into 2020, drop my mic, okay. Going out of 2021, going into 2022, the S&P 500 had a 10% correction, okay? Basically what the markets were saying early on this year, inflation's taken off, we have to raise interest rates to fight it, and they're basically trying to price in those rate hikes, okay? They're pricing in the economy slowing down, okay? Well then, another thing that we saw during that time was we saw a massive sell coming out of growth stocks. These are typically like your techs, your Facebooks, your Googles, your Amazons, Netflix, Ubers, Teslas, all that stuff. So you're not focusing so much on growth and economic growth. You're focusing and you're shifting your money out of growth going into value stocks. I like to call these guys your dividend payers, your AT&Ts, consumer goods like Procter & Gamble, banks and financial stocks like Visa and MasterCard and Bank of America and all that jazz. So we saw a 10% correction in the market. We saw everyone shifting out of growth stocks going into value stocks. And then we had the Fed meeting come, the Federal Reserve came out and we were all just expecting them to raise the interest rates. This is what they said. With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target rate. What kind of non-definitive garbage is that? So basically they said, we're going to push the rate hikes until March. And so since then, everyone's basically like, oh, we're going to have 3 rate hikes. We're going to have 7. We're going to have 6. And so everyone's just kind of, well, we got inflation. That's a problem. And now they're pushing it off until March. What's going on? I don't necessarily think, I think the Feds will be, and I could be wrong, I think the Feds are going to be forced to raise interest rates. I think they're going to have to. However, I don't think they can afford to raise interest rates as much. What do I mean? Something that a lot of you probably didn't keep in the back of your mind since walking into this room is we got midterms this year. Yay! Politics. Anyway, so let's just take a little bit of analysis of the current situation. You have Joe Biden, a Democrat, in the White House. You have Nancy Pelosi, a Democrat and majority leader in the House of Representatives. You have Chuck Schumer, a Democrat, and the majority leader for the Senate. And just using a little of emotional intelligence, and let's just think about this. If you woke up tomorrow morning and you're a Democratic representative and your seat is up for re-election this year in November, would you rather go on the campaign trail facing tough questions about inflation, or would you rather go on the campaign trail to face tough questions about a recession? You would be genuinely surprised how much political pressure our central bank is under. So pick your poison, stuck between a rock and a hard place. I don't necessarily think just because it is an election cycle and the political pressure, I think the Feds will be forced to raise interest rates, but not that much. One other thing. And Jim was never in the business of making predictions. I don't intend to take on that mantle either. With midterm elections, historically speaking, there's not that great of a voter turnout compared to the general election. When we get to 2024, when we get to that general election, there's a lot more meat and potatoes that I can go into that I think makes our job a little bit easier as advisors in the politics and stuff. But if there is a red wave, if the Republicans take over either the House or the Senate, you create political gridlock, okay? Now, in that situation, and this is not me, this is just how they call things, Joe Biden will be then a lame duck president, okay? This is not me, this is the internet, okay? So when you have that political gridlock and you have a president that can't pass a lot of pass any laws because the Republicans in the Senate or the House can't work with the Democrats in the Senate or the House or whatever, when there's that gridlock, it takes pressure off of Wall Street to focus so much on what's going on in Washington and then kind of redirects that focus back to the economy and inflation and the earnings and stuff like that. So there's that. So that's one big reason why I think they can't really afford to raise interest rates all that much this year. The other reason is the fact that our national debt is now above $30 trillion. Oh, I'm going to ruin you. Fun little fact about the national debt. 2/3 of our national debt, 2/3 of this $30 trillion is comprised of two things. Not defense spending, not welfare, not food stamps, just two things, Social Security and Medicare. 20 trillion of this $30 trillion is just Social Security and Medicare. When you raise interest rates, you not only make it more expensive for businesses to operate, and that obviously hurts the economy, you also make it more expensive for the government to operate, okay? You make it more expensive for the government to borrow money. And so if you raise interest rates too much, you're gonna see this $30 trillion just keep going up at a faster rate. So, one last thing before I pass it off to Jaimee, and I'm gonna try not to steal too much of her thunder. Coming out of 2021, going into 2022, within our own company and even kind of abroad, we saw a lot of greed. When I was a broker at Schwab, I used to be a stockbroker, and at Charles Schwab, my old employer, every broker on the floor knew the dry ship story. It was infamous. Everybody knew it, okay? Dry Ships is a shipping company based out of Athens, Greece. When the stock traded on the market, it was below $1. We would classify it as a penny stock. Penny stocks are very volatile. There's not a lot of information on these companies. Honestly, you got better chances with the lottery than buying penny stocks. So one day, Dry Ship stock just goes absolutely parabolic. Just 500,000, 1,500% on the day. Just rocket ship, right? It's just going up. Well, Schwab and all their technological infrastructure gets a little warning sign, danger, Will Robinson, danger. There was a client who had a very sizable position in Dry Ships, and his account was just blowing up. And so Charles Schwab, being a good company, and they don't want to get sued, they actually had a broker call the client and say, Mr. Client, I'm just letting you know, Dry Ships is going parabolic. The price of the stock has gone up astronomically. And you'll never, ever, hardly ever hear a broker say this on a recorded line. We highly recommend that you sell now, capture your gains, and move on. This obviously is not a story worth sharing in front of a giant group of people if the client didn't think of himself as other than an absolute genius. He, of course, said, oh no, it's fine. This is my new #1 stock. I'm going to retire early. It's going to keep going up. And the broker's on the phone, and he's like, are you sure? Because if I didn't know any better, this is like a classic pump and dump scheme. And sure enough, he just didn't want to have any of it. You guys remember Wile E. Coyote? At the open of the market, the very next day, Dry Ship stock. I didn't want to be too early, but anyway. So Jaimee's going to talk to the other extreme of market emotions, but I wanted to share, going into this year, greed is a hell of a drug. It really is. It helps kings conquer worlds, and it leaves investors, not her, but it leaves investors holding empty bags. Now it's Jaimee's turn.
Oh boy. Well, that's quite the intro. Well, hi guys. In case you haven't noticed, I overindulged on Christmas cookies, and I'm, still need to work that off. But got a little greedy. Just kidding. But in all reality, Daniel and I are going to have another son in about 5 weeks. My husband. Oh my goodness. But anyway, so thanks so much that was nice, a good lead in that Daniel had talking about greed. But really, I just want to take some time to talk through market emotions. It's quite a roller coaster. Oh, I'm going to go the other way. So kind of, I thought this graphic right here was pretty much prime example of the emotions you go through, right? The terror, the excitement, all over the place. So we'll talk through what is the roller coaster of emotions that you can go through. Then we'll talk through some pitfalls that you just need to be careful of as an investor, and ways that you can kind of overcome those. So, prime example of volatile markets and ups and downs and ups and downs and ups and downs is COVID, right? So you can see the red are the down price swings, and this is pretty much week by week actually, and the greens are the ups. So you have days where it's up at 10%, you have days where it's down, 12%. Up and down, crazy, crazy volatile market. So if you think through emotions on those days, if you checked your account on this day, maybe you're not feeling so great. If you're checking your account on this day, you're like, oh, okay, things are coming back. So this is just a real life example, a very short amount of time, right? We're talking end of February to end of April, so 2 months' time, crazy ups and downs. In a short amount of time, that can happen. Does it happen all the time? No, but it can happen over a short amount of time. So I'm going to take you on a roller coaster ride. So the cycle of market emotions. We all start right here, and then it starts to go up. And you're like, okay, I'm feeling pretty good. Things are going well. You start to get excited, maybe a little bit giddy. You see your account growing. Guy in dry ships maybe is excited to see it going up. You think you're going to be a millionaire. And at the very top, we have euphoria. So the best you can feel, you're like, I am the smartest investor ever. Or I hired the smartest investment advisors in the world. They're making me tons of money. You are so excited. At that point, you are at the maximum financial risk. So think about dry ships. Things had grown, he was at the top, maximum risk. You feel great at that time, and you think things can only go up from there. That's what they've been doing. Why would I need to do anything else? Let's throw the money all in growth stocks. Last year we had some clients that said, hey, I need to go all into stock. And usually when you start to hear that, we as advisors are like, oh, when you start to hear people, I need only in this, getting away from things that can help round out your portfolio and cushion it, we kind of feel that we're getting pretty close to this top. It's not for sure, but it's pretty close. Then, as the roller coaster goes, right? No roller coaster goes up forever. That would be a boring ride. So then it goes down. Markets are cyclical. So as it starts to go down, start to feel a little anxious. Then maybe start getting scared. Start to feel a little desperate. And then you keep going. You're like, it can't get worse. And then it does. You start to panic. You're like, oh, what's going to happen? I'm going to have nothing. You get all the way to the bottom, and you're like, I give up. I don't know. I'm going to be broke. I'm going to go live on the streets. That point, we have seen a lot, too. In that COVID example, we had 2 clients. I know we've told the story before, so I'll keep it short. Probably at this point say, I can't take it anymore. They're crying. I cannot take it any longer. And at that point, that's pretty much the bottom. It's the maximum opportunity. And it goes against emotions, right? When things are down, you were like, I want to take things and protect it. It goes against, it goes against your emotions to say, hey, this is the time of opportunity, not a time to sell out and keep what you have. So then, like I said, cyclical. So you hit the bottom right here. You don't sell, because that's what we help you to do. And then things start to come back, and you start to get a little hopeful. You start to get optimistic. And then we start all over again, because we have optimism here. So it's quite the roller coaster of emotions, right? If you're watching every day, that can take a big toll on your emotions. So that's kind of the cycle. Obviously, the markets usually don't start at, we're going to say this is ground zero, right? And it goes up, goes down, and end at zero. Over a long period of time, the markets do tend to go upward. That's why we invest. So yes, it's cyclical, but on the long term, it goes like this, up and down, but it tends to go up. So, as Daniel said, the two worst enemies you have are greed and fear. So Daniel talked about dry ships and greed and how that can happen, and then I'll have an interesting story about fear and what that can do. And boy, if you guys haven't looked at the world today, we are in the age of fear. Somebody said once that the strongest emotions were love and hate. As time's gone on, I'm thinking that one of the strongest emotions is fear. Fear makes you do some crazy things. It's crazy what a hold it can have on you. So with that fear, you just need to recognize it and make some smart decisions, and we can help you do that. If you go with this cycle, right, buy when things are high and sell when they're low, repeat till broke, right? So our goal is to help you do the opposite. Buy things when they're low and you have opportunity, and help you sell things when things are high. I'm just going to skip that one. So talking through fear, I worked at Vanguard, Charles Schwab's competitor. I rarely have I ever seen an account go to $0. Yes, it can go down, but I saw somebody invest $1 million and it went to zero. Almost can never happen unless you're doing some really wild stuff. And this person was. So I had talked to them, and I talked to them, so when Trump was going to be elected, I think he had just won the election, and this person was sure, he was so afraid of what this person could do, of what he could do as a president, that the markets were going to absolutely tank. So what did he do? He betted against the stock market, and he betted 3 times. So if the stock market went down $100, his account went down $300. So like in inverse of that. Because he was so afraid of what the world was going to look like with this new president. So what happened during that time? Things kept going up. And I know hindsight's 20/20, but things kept going up. And his account was the inverse. So when the markets went up, his account went down. So his account went from $1 million to zero, absolute zero. So it's just crazy what fear can do to you. And it's not just a Trump story. I've seen people make similar mistakes or pull their money out when Biden was elected. So it's just all about fear, not a side specifically, but fear of what could happen. So, as promised, I think I have about 7 things that typical investors or typical people, behaviors that they have to fight against in order to be successful. So one right here, volatility is emotional, right? And when you see the markets going up and down, you can forget what your goals are. Why are you investing? Are you investing for your retirement? Are you investing for your children's education, et cetera, et cetera? And if you see the markets going up and down, if you see them going up, you can get greedy and expose yourself to too much risk. And if you're not keeping your goal in mind, then you could be too risky and lose what you have. Vice versa, you could be so scared of losing anything that you're not keeping up with inflation. Daniel talked about inflation, and it's quite a beast. We have right here a $100 trillion bill from Zimbabwe. This is what inflation could happen. I'm not saying it's going to happen in the U.S., but if you're so scared of losing anything, your dollar is going to buy you less and less, and then you're not going to hit your goals of having enough money because your account's not growing to keep pace with the cost of goods going up. So just keep in mind, what are your goals? Why are you investing? What is your money for? Another thing that you have to be careful is we all like instant gratification or instant feedback, right? So oftentimes advisors can look and say, what happened the last month or the last 2 months? We saw the crazy COVID cycle, that was a 2-month thing. And if you look at a short time period, maybe just even the beginning of this year, it's been wild. If you look at a short time period, you can make a decision that's not the best. If you're looking, last year things are up, well, then maybe you're going to say, let's get more risky, let's take on more, let's grow more. Or if you're looking at a short time at the beginning of this year, you could be tempted to say, it's time to sell, get me out, this is not good. So don't make decisions based on short term. Over the long term, that's where we have some more confidence in what's going to happen. Micromanagement, we all love that, right? As you thinking through your, when you were employed and all that jazz. Micromanagement, it's something you make you feel in control, saying, I'm going to buy this and this and this and this. But when you micromanage it, sometimes your emotions get involved in that, and it helps you make not the best decision. You feel better because you're saying, do this, but oftentimes we see our clients and we see the ones that just let us manage the money, and we see it grow really well. And those that are trying to micromanage, sometimes we compare apples to apples to say, hey, how is it, how are things going? Oftentimes when they just let us do our thing, it performs well, and when there's micromanagement, sometimes it doesn't perform as good. So I thought this Dilbert was perfect. Just a little nod to micromanagement. In case you can't read it, I'll read it for you. I've decided to be a more hands-on manager. Move the mouse up, over, click it. No, you fool. So, kind of a prime example, right? Buy, sell, do this. Just a little nod to controlling things. This one right here is a huge one. The media, things that you hear, sometimes it's just noise. Sometimes it's legit, but sometimes there's just noise, and it makes it so hard to say what's actually happening in our world, what's unbiased, what is really real news that that's going to impact the stock market, and what's news that's really just noise. So sometimes with that, you just have to be really careful. What are you listening to? If you listen to the news, sometimes you think the world's going to end every single day. That's what I've noticed lately. So I have to be careful what I really listen to and believe. So just be careful what you're taking in, and be careful if it's going to let you have you make a decision or not. Finally, we also believe that we're better at investing than we are, right? So this little graph right here, the more confident you are that you're like, I got this, I'm smarter than anyone. Mr. Dryships, he thought he was smarter than everyone, right? So he was really overconfident. That's his stock. That's what's going to make him retire. But he was so far over here, his mistake was huge. It cost him probably thousands of dollars. So yes, it's good to have confidence, but an overconfidence is a little too much. Can cause your mistakes to be amplified. I'm going to kind of breeze through that one. We've talked about it already. We detest loss so much as humans, right? You hate loss, you hate failure, any of that. So because you hate it so much, nobody's out there bragging, I lost 5% on my account on this investment that I made. Nobody's out there doing that because we hate loss so much. And sometimes because we hate loss so much, we don't make very smart decisions. So that can look like keeping a ton of money in the bank. Yes, have some money in the bank because it's good to have, a liquid emergency fund, that sort of stuff. But if you're so scared to see that go down at all, and you don't want to lose anything, your money's not going to be able to grow and keep pace with the cost of goods that's going up. So those were kind of the big emotional behaviors you have to look out for. Most people have a few of them. I have them too. So it's just good to be aware what are things that can cause you to make an unwise decision. So that's kind of first. So how do you become a successful investor and not let emotions dictate your investing? So the first one is purely realize what you're thinking, realize what's causing you to have these crazy emotions that might make you make an unwise decision so that you can avoid them. So that's why I shared some of those, so that you can start to recognize what are things that could make me make a bad decision. 2, learn from mistakes in the past, right? So the investor that bet against, was so terrified of Trump getting in, or Biden, maybe not do that, like recognize what happened and then go forward. Don't let it stop you from investing, but recognize what's happening, recognize any mistakes you've made in the past and go forward. So I have said before, 3, stick with a long-term plan that's based on your goals. So think through, like I said, longer term over a longer time. There's less volatility if once you spread that time out. We're not talking 2 months. We're not talking, a few weeks. We're not even talking a year. What's your long-term goals? And stick to your goals. So make sure that we know your goals as your advisor, so that we can help plan for it. So we can help make sure you're in the right level of risk and you're in the right area where you can grow, appropriately. 4th, turn off the news, or just don't, if you hear news of the stock market not doing so well or doing really well, maybe don't look at your account for that short time. I'm not saying don't know what's going on. I want you to know what's going on in your accounts, but to help you not be super emotional, sometimes when you know that it's going to either be not good or really, really good, don't look. Or don't check every day. Maybe it's I check once a month sort of thing. And then the last one, use us as your financial advisors to help. When you're feeling stressed out, when you're feeling emotional, give us a call. You can email us. We want to help you make good decisions. So feel free to utilize us. Like Jim said, we could manage money all day long, but the part where we can bring a lot of value is helping make sure that there's no unwise decisions that get made. Yes, we really care about your money and want it to grow. That's my goal. That's all of our goals. But we didn't work hard for it for years and years, so we can take the emotion out. We can say, we're going to take the emotion out. We're not going to go by these, all these behavioral, emotional items that I talked about, and what's the smartest decision? What's the decision that's going to get them to their goals? So we can separate that easier. Then it's a little bit harder to separate what's the logical answer when you've worked really hard for it. So we can take the emotion out and make sure that we're making good decisions for you. So that's it with the behavioral discussion and how to be a smart investor or things to look out for. We have surveys on the table. Jim mentioned them before. If you could complete it, we appreciate any feedback. Like I said, last time they said we needed more Reese's. We did that. We fixed the microphone issues from last time, hopefully. If not, let me know. So we really do read them and want to know, things you like, things you don't. And then obviously any questions, we're always really happy to answer those for you. Also, a side note, you probably saw them, but we have cute little mugs that have some sign sayings, so you're more than welcome to take those. A lot of them are different, so if you want to at the end, you can always look through and see which ones we have. And then, as Jim said, if you have questions, jot them down on your sheet, just so that we can make sure to address your specific situation instead of a kind of a response that might not have all the details that we need. So go ahead and do that. If you guys have any questions, obviously here's our contact info. But thank you so much for coming today. We really appreciate you.